Hello guys, a lot of talk lately about silver falling again, gold looking weak, and precious metals failing to do what people expected them to do during a geopolitical shock. So in this video, we're going to separate the scary price action from the actual market setup, and you are going to walk away with a clearer idea of what is pressuring silver, what is noise, and what could change next. And today is Thursday, April 30th, New York time. So comment below what day and date you're watching from, because with markets like this, a price that looks dramatic in one session can look completely different by the next open. Also, if you value this kind of calm breakdown, subscribe and comment John AG Best below. That lets me know you want more of this style of analysis when the market starts acting emotional. So let's start with the obvious. Silver is down again. Gold is soft. Platinum has been hit harder than the others. And on the surface, it feels like precious metals are sending one very ugly message. But I don't think the message is that simple, because the asset moving the whole board right now is not silver. It is not even gold, it is oil. And that matters because oil does not just move in one corner of the market. Oil touches inflation expectations, bond yields, the dollar, consumer confidence, transportation costs, and the way traders think about risk. So when oil jumps because of tension around Iran and a critical shipping route, the market does not calmly say, okay, buy metals. It scrambles first. That scramble is what we are seeing. So if silver is supposed to be yields push around because the market starts wondering whether the Fed can cut at all. And gold and silver, even though they are hard assets, can get pulled lower in that first wave. That does not mean the long-term silver thesis is dead. It means silver is being treated like a market position before it is being treated like monetary insurance. There is a big difference. Now, based on the latest publicly available energy updates, crude has been trading near levels that force everyone to pay attention again. One major forecast recently had Brent averaging just over $100 in March and peaking around the mid-100s in the second quarter before easing later, assuming supply disruptions slowly improve. That tells us something important. The market is not only reacting to today's headline, it is also pricing a risk premium that may stay around for a while. And then you have the straight issue. Recent oil market updates showed shipments through that route being severely restricted, with flows far below normal levels. That is not a small detail. That is the kind of disruption that changes shipping routes, insurance costs, refinery planning, and physical barrels. So when people say, why is oil still high? Part of the answer is simple. The market is paying for uncertainty. But here is the counterpoint. High oil is not automatically bullish forever. High oil eventually becomes its own break. Consumers drive less, airlines raise prices, trucking margins tighten, businesses delay spending, refiners adjust, demand starts responding. So yes, oil can squeeze the economy, but oil can also squeeze itself. That is why I would be careful with the idea that crude can just rise endlessly and silver must keep falling endlessly. Markets do not work in straight lines. They stretch, they panic, they overprice risk, and then they reverse when the pressure point changes. Now, the Fed did not really rescue metals either. The latest decision kept policy steady, with the benchmark rate still in the mid-3% range. The statement also pointed to uncertainty around the Middle East and risks on both sides of the mandate. In plain English, that means the Fed is not looking at this setup and saying, everything is fine, but it is also not rushing to cut just because markets want relief. That matters for gold and silver, because gold and silver do not pay interest. There is no dividend, there is no coupon. So when yields stay firm, some investors look at metals and say, why hold something that pays nothing? That thinking can pressure prices in the short term, especially when charts are already weak. But let's not stop there, because that argument has a limit. If yields are high because the economy is strong, that is one story. If yields are high because energy prices are causing inflation anxiety while growth starts slowing underneath, that is a different story. And that second version is much less comfortable. That is why I keep coming back to the word unsustainable. Not because silver cannot fall more tomorrow, it absolutely can. Not because gold has to bounce immediately, it does not. But because expensive energy, tight financial conditions, cautious consumers, and geopolitical uncertainty are not a healthy combination for very long. Something has to give. Maybe oil cools. Maybe diplomacy improves. Maybe demand weakens. Maybe the Fed changes tone later. Maybe the dollar stops helping sellers. I do not know which one happens first. But the current setup is not stable. Now let's talk about inflation for a second, because this is where a lot of commentary gets sloppy. A jump in gasoline prices is not the same thing as money printing. It is a price shock. It can make life more expensive, and it can feed into other prices, but the original cause is different. Money supply inflation is broader. It is about the amount of money and credit in the system. And from recent monetary data, the money stock is still huge compared with the pre-pandemic world, even after some tightening. So we have two things happening at once: an energy shock in the foreground and a large monetary base in the background. That is exactly why this feels confusing. The short-term market sees oil and says, higher inflation, fewer rate cuts, stronger dollar, pressure metals. The long-term investor sees the debt, deficits, monetary expansion, and geopolitical distrust and says, hard assets still matter. Both can be true. And if both are true, then a down day in silver does not automatically destroy the long-term case. It just means the short-term trade is being dominated by liquidity, yields, and dollar strength. Now, let's bring in gold because gold is giving a different signal. Based on recently published demand numbers, central banks bought roughly 250,000 tons of gold in the first quarter, even with prices elevated and some selling showing up. That is a strong signal. Central banks are not buying gold for excitement. They are buying it for reserves, optionality, and protection against a world where trust between major powers is not exactly improving. And this is where silver investors should pay attention. Gold often leads the monetary story. Silver often follows, but with more volatility, more drama, and more industrial baggage. So when gold corrects and central banks still buy, that tells us the reserve story has not gone away. But silver has an extra problem. Silver is part monetary metal and part industrial metal. So if the economy slows because oil is too high, silver can get hit from the industrial side. If the dollar is strong, silver can get hit from the currency side. If traders reduce risk, silver can get hit from the liquidity side. That is why silver can look terrible even when the larger hard asset argument is still alive. It is not clean. It is a tug of war. And right now, the industrial and liquidity side is pulling hard against the monetary side. Now, gasoline prices matter here too. The national average has been around the low $4 range again, which is painful because fuel prices hit people immediately. Nobody needs a spreadsheet to understand that. You see it at the pump. You see it in delivery costs. You see it in airline tickets. You see it in food distribution. That is the real economy link. And once the real economy starts feeling it, markets begin asking a different question. Not just, how high can oil go, but how long can households and businesses absorb this? That is where the Iran situation becomes bigger than energy. One side may be under heavy pressure economically and politically, but the United States is also under pressure in a different way. Higher gas prices create voter frustration. Higher oil creates inflation frustration. Higher inflation keeps the Fed cautious. A cautious Fed keeps financing conditions tight. So this is not a clean victory for anyone. It is a pressure contest. And in a pressure contest, the real question is not who can sound stronger. The real question is who has the shorter clock. That is why I do not think the current oil path is comfortable for policymakers, markets, or consumers. It might continue for a while, but the longer it continues, the more consequences it creates. Now, what does that mean for silver from here? In my opinion, silver is near an important psychological zone, not because of one exact price, but because the narrative is getting tested. If silver stabilizes while oil remains elevated and the dollar stays firm, that would be meaningful. It would suggest sellers are losing control. But if silver keeps sliding while crude keeps rising, then this is probably not just a normal correction. It may be a liquidity event, where traders sell first and think later. That kind of move can overshoot, and overshoots are painful, but they can also create the conditions for the next serious move. So the key is not to panic and not to romanticize the dip. Both are mistakes. Panic makes you sell without a plan. Romanticizing the dip makes you buy without respect for risk. A better approach is to ask what has changed. Has the Fed changed? Not really. Has the energy shock disappeared? No. Have central banks stopped buying gold? No. Has the long-term debt and currency story improved? No. Has silver's short-term technical picture weakened? Yes. So the answer is mixed, and that is exactly why this market feels uncomfortable. If you're successful, share your success story in the comments so others can stay motivated. There are a lot of people watching these moves who need to hear that discipline matters more than emotion. And I want to ask you this. Do you think oil is now the main driver for silver? Or do you think the dollar and Fed are still more important? Drop your view below, because this is one of those moments where the comments can actually add value. Putting it all together, silver is falling because several forces are hitting at once. Oil is raising inflation fear. The Fed is not offering easy relief. The dollar is firm. Yields are not making life easy. Technical traders are cautious, and geopolitical risk is making everyone defensive. But the bigger picture is not gone. In fact, the bigger picture may be why this matters so much. Because if the system were stable, oil shocks would be easier to absorb. If debt were lower, rates would be less dangerous. If supply chains were simpler, shipping disruptions would matter less. If currencies inspired more trust, central banks would not be buying so much gold. So silver's weakness is not proof that precious metals are useless. It may be proof that the system is under stress. And during stress, the first move can be ugly, before the second move makes sense. So I would not root for chaos. I would not root for oil to explode higher. I would not root for conflict just because metals might benefit later. That is not a win. A broken economy is not a good metals thesis. What we want is fair repricing, functioning markets, and enough calm for people to make rational decisions. For now, watch oil, the dollar, yields, and whether silver can stop falling on bad news. That will tell us a lot. One more thing that matters is the difference between a price spike and a lasting repricing. A spike is emotional. A lasting repricing happens when companies, governments, and households change behavior. If refiners keep fighting for replacement barrels, if insurers keep charging more for risky routes, and if buyers keep bidding for safer supply, then oil does not need a fresh headline every hour to stay expensive. The structure itself keeps pressure in the system. That is the part silver investors should watch carefully. Not just the headline war risk, the plumbing. Because metals often respond late to plumbing problems. At first, everyone watches the front month price. Then they watch inventories. Then they watch spreads. Then they watch whether physical users are willing to pay up. By the time the average person notices, the deeper adjustment may already be underway. And this is why I do not like oversimplified takes. Oil up, silver down is too shallow. Inflation up, silver up is also too shallow. The better question is, what type of inflation, what type of demand, and what type of stress are we dealing with? If the stress is mainly fear, metals can get sold with everything else. If the stress becomes distrust in policy, currency, or supply security, metals can begin acting very differently. That transition is the cliffhanger. We are not fully there yet, but we may be moving toward it. Also, keep an eye on the timing between sessions. US markets can close ugly, Asia can reopen with a different tone, and by the time New York wakes up again, everyone acts like the prior move never happened. That is why chasing every candle is dangerous. Silver can punish overconfidence in both directions. So the practical takeaway is simple. Do not ignore the sell-off. Do not worship it either. Study what is driving it. If oil cools and silver still cannot bounce, that is a warning. If oil stays hot and silver stops falling, that is also a signal. Markets speak in reactions, not opinions. And that is why I keep the view flexible. Silver does not need perfect conditions to recover, but it does need selling pressure to lose momentum. The first sign will not be a dramatic speech or headline. It will be a quiet failure to make new lows when bad news is still everywhere. And remember, this is educational commentary, not personal financial advice. I'm sharing how I'm reading the market pieces, not telling you what to buy or sell. Your money, your risk, your timeline, and your responsibility.